Okay, so this is the 2016 or 2018 DEB mock manufacturing account. It's relatively straightforward. It's more standard than the 2016 examcraft one that we looked at last time. So again, we'll just go through the workings, see if anything comes up that we don't understand. So first one is your closing stock. So you're given your 3 closing stocks, and then you're told the finish for finishing good, or the figure for finishing goods includes stock, which are cost 5.4, and now is a net realizable of 3.6. So we know we take that 65,000, get rid of the 5.4, and add on the 3.6 because you value stock at the lower of cost or net realizable value. So that's standard enough sort of working. Working 2, included in the figure. Included in the figure for sale of scrap material is 2,500 received from the sale of an old machine on the 31st of the 3rd. The machine had cost 16,000 on the 1st of the 7th, 2002. So what we need to do is we need to tie that in with the depreciation of machinery working, which is the next one down. So these two go together. Okay, so just first of all, we'll take the sale of scrap material. That 2.5 should not be included in the sale of scrap material. You do your normal depreciation working where your normal disposal of asset working where you take it away from the asset, get rid of the depreciation, work out the profit on the sale of the asset. So the sale of this 2.5 is not sale of scrap, so we remove it from sale of scrap. So we've got 5.6, and we're going to take away that 2.5. Okay, now the next working is the depreciation working then. So it says provide for depreciation on plant and machinery at the annual rate of 10% of cost from date of purchase to the date of sale. So we have depreciation of machinery, and it's 10%, and it's from date of purchase to date of sale. So I'm going to write that down twice. So we've got our machinery started off as 240,000, which I really should put in here. So I'll do that first. So we've got machinery started off at 240 minus the old machinery then. So normally it could be a trade in, but it's not in these ones generally. So we're taking away this old machine that it cost 16,000. You hadn't bought any new machine. So that goes down to 240 minus 16, which is 224. Oh God. Sorry. Okay, so your depreciation is then 10% of the 240 by 3 months. So you sold the machine on the 31st of the 3rd, so it's about 3/12. And then you had 224 for the remaining 9 months. Okay, so we'll work out those sums. So okay, so we'll add the two of those together, and that's your depreciation charge for the year. So 22,800. So from there, you need to work out, as always, your accumulated depreciation. So your accumulated depreciation started off as the difference between the 240 and the 185. So that's 55,000. You need to add on that 22.8 and take away the depreciation of the old van, or the one you sold. So the one we sold is the 16. Is the 32. Sorry, the 16,000. The one that we cost. So that's going to be 10% of 16,000 multiply by the number of months we had it for. So it had cost 16,000 the first of the 7th, 2012. So we have it for 6 months in 2012. We have it for all of 13, 14, 15, and 16. So that's 4 full years, 13, 14, 15, 16. So that's 48 months. Plus another 6 in 2012 is 54. And then plus your 3 in 2017 is 57. So we're going to take that out. And that is 7,600 that has to be taken away. So we'll work out our answer for that. So that's 55,000 plus the 22,800 minus 7,600. Okay, and that's 70,200 there for our accumulated depreciation. Okay, so now, anytime you've disposed of an asset, you look at the profit or loss on the sale. So you compare, to do that, you compare its value. So the value of the asset is 16,000 minus 76, which is 8,400. Compare that to what you got. So we received 2,500. That means we made a loss of 5,900. Okay, so that's that one done. That's 2 and 3 done at the same time. Okay, number 4, suspense working. Now the suspense figure arises as a result of the discount allowed of 1150 entered only in the debtors account. So discount allowed should go into debtors and discount. So it's credit debtors because it reduces debtors and debit discount. So discount allowed is an expense. So we're debiting discounts. So let's have a look at discount in the question. It's a net position of 8,400. So it's a credit of 8,400. If we're debiting the discount, we're taking it out. So we're debiting 1150. So the net position is going down. So we'd received 8,400, but there's a discount allowed, an expense of 1150. So it reduces the overall position. Okay, so what does that do to whatever incorporates suspense then? So selling expenses incorporated as suspense. So selling expenses are 26,400 on the debit. Now we have debited the credit side. This side has gone down. The credit side has gone down by 1150, which means the debit side also has to go down by 1150. So we're going to take that away. Okay, to make that balance. So this is 1150 less, and now this side is 1150 less as well. The next part is 3,000 paid towards PAYE and PRSI and USC entered only in the bank account. If you pay PAYE, PRSI, and USC, it reduces your liability. So it's credit bank, so that it reduces your bank balance, and debit PAYE, PRSI, because PAYE and PRSI are something that we owe to the government. If you pay it, you no longer owe it. So PAYE, PRSI is 80,000. And we're going to have to take away from that or debit from that a 3,000. That'll get you to 77,000. So again, what's happened? The credit side has gone down by 3,000. Okay, this was 80, it's now 77, which means this side has to go down by 3,000 as well. So whatever incorporates suspense, so the selling expenses go down by 3,000. So that's 22,250 for our final position for that. So Was it selling? So yeah, that's correct. All right. Um, so next one then. Uh, Sorry, I'm after getting a little bit lost here. Sorry, where am I? So we've done that. Just want to make sure that, yeah. Next one. Uh, it was discovered that goods had been sent to a customer on a sale or return basis. Now remember, if you sell something on a sale or return basis, the prudence concept kicks in. You have to assume that they will be returned to you. So therefore, you've never sold them. So the goods had been entered in the books as a credit sale of 12,000, which is a markup of cost of 20%. So sales and debtors need to go down by 12,000 because that sale has never taken place. So sales is 1455, and we need to take that down um, by 12,000. Debtors is the same. Debtors need to go down by 12,000 as well. So debtors is 46.2, and we take 12,000 away. What it does mean is that our stock of finished goods is going up by the cost price. So I'll just work that out. But this cost price of stock isn't going in, but if it's 12,000 and it equals cost plus a markup of 20%, so it's a markup, it's cost plus 20%, uh, we're going to divide that by 120 and multiply by 100, and that'll get you back to the cost price. So it's 10,000 euros. So we need to add 10,000 euros back onto stock of finished goods because we still have this stock here. Okay, so that's that one. Next one is your bank reconciliation statement working. Now, you haven't seen one of these in a while, let's say. So um, the figure for bank and the trial balance has been taken from the firm's own records. So this number here is from our records. Where's bank? Minus 59,500. So that's what we're saying is in the bank. Uh, However, a bank statement from the end of the year has arrived showing an overdraft of 55,100. So the banker saying it's minus 55,100. Okay. A comparison of the bank statements has received the following discrepancies. So this is your bank rec statement. So a check for 600 from a debtor has been dishonored. This has not been entered in the books. It's not saying it's a bad debt. It's just saying that the check has bounced. So when a check bounces, you see this in service firms quite a bit. You have seen it in recent years. The amount in the bank goes down. So we have received a check. We have assumed that the check had cleared. It hadn't. So we have put 600 into our bank account. The banker is saying we don't have it. So the bank's figure is correct. Ours is wrong. Debtors goes back up by 600 euros because they owe us the money. So we had taken it out of debtors, um, and obviously if the check bounces, the debtors don't. They still owe us the money, so we have to put it back into debtors. Next one, investment income of 1,000 will be paid directly into the firm's bank account. So again, it's in this one here. This is the bank's record, 55.1, but it's not in ours. We've received 1,000 euros there. Now, the double entry from that is that investment income due gets reduced. So I'm going to work out the investment income now, so we can help work out the investment income due as the double entry. So the investment income is 3% investments. So 3% of 200,000, but you got the investments on the 1st of the 6th, so you only have them for 7 months this year. So from the 1st of June to the 31st of December, 7 months. So the investment income is going to be 3.5, and the investment income due is going to be 3.5 minus that 1,000 that we've received. Now there might be more to that later, so we'll just leave that blank. So that's the double entry there. Goes into the bank, comes out of investment income due. Okay, and the third one, a check for 4,000 issued to a director had not been presented for payment. That means we've put it in our accounts, so that one is correct. And then this 4,000 is wrong. So that's 59.1. And then this is 59.5 minus 600 plus 1,000 will be 59.1 as well. So you got it to balance now at this stage. The key to that is making sure you do your double entry. Okay, next job. The figure for advertising is for an 18-month campaign which began on the 1st of the 9th. So this number up here for advertising, whatever it is, has to be split up into advertising and advertising prepaid. So we're just going to basically cross out this number. It's now in irrelevance. So that 3,600 is for a 18-month campaign which began on the 1st of the 9th, 2017. So that's 9, 10, 11, 12. So 4 months of it this year. So 4/18 of the number of the 3,600 is for this year. So is our expense, our selling expense, and it's 6. That should be 4/18. And that's 800. The remainder then, 2,800, is advertising prepaid, which is a current asset. That's all it's asking you to do with that. So cross out this number. It's no longer relevant to us. The 3.6. All right, the factory working then. During the year, Gill built an extension to the factory. The work was carried out by his company's own employees. The cost of their labour, 15,000, is included in factory wages. So what we're going to do there is take it out of factory wages. So it's where's factory wages here? Direct factory wages 165,600, and we're going to take out the 15,000. Now that 15,000 doesn't come out of there. It has to be included in buildings as well. So buildings at cost were 1,350. We can add on another 15,000. Same then goes for the materials cost and raw materials were taken from stock. Now they're taken from stock, so they're not included in closing stock. But that is purchases of raw materials that has to be adjusted. Now, normally purchases of raw materials will be changed, but it's not in this case. So we'll take that purchases of raw materials of your starting figure of 462,400. And we're going to take away from that the materials that are taken from stock, 65,000. And again, same process, it's just a movement. They get added in to buildings. So buildings in reality have gone up by 80,000. There's no depreciation of buildings, which is grand. So, or no revaluation. There normally would be. Okay. Sorry. Okay, our last job is the creation of a provision for bad debts, 4% of debtors. So we're creating this. So BDP, 4% of debtors, obviously 4% of the new debtors figure. So debtors is this here. $600. Sorry, plus 600. So 34.8. So 4% of that is 1392. And then that also becomes an increase in BDP, which of course is the selling and distribution expense. Okay, so that's all our workings. We can finish them out. It seems to be all of our numbers bar this. These two. So assuming I haven't made any calculator errors, I've done all my double entries there. So I'd hope that this will balance. So again, what we'll do is we'll see where everything goes. Excuse me. There's no splitting up numbers or anything here, so it's just a case of uh, throwing them in. So stock finished goods is finished goods, so it's trading and current asset. The sale of scrap material, and that always goes in your manufacturing because it's obviously to do with scrap material comes from building stuff. Machinery is a fixed asset. Depreciation of machinery, again, machinery is used to make stuff, so it's manufacturing. Accumulated depreciation will go on the fixed assets. The loss and disposal, well, it's disposal of machinery, so it's manufacturing again. The discount is selling and distribution. That's a credit actually, so it's other operating income. Selling expenses will be your selling expense in the profit. PAYE is a current liability, credit balance, so could be a debit, but it's not. Sales will go in the trading account. Debtor is a current asset. Now, just make a note that there's a bad debt provision there. The cost price of the stock, that was just to work out figure earlier, so I'll get rid of that. Bank is a minus figure, so it's creditors or current liability. Investment income will go in the trading and in the profit and loss section. Investment income due, of course, is a current asset. Advertising is a selling, just loads of selling ones. Advertising prepaid, current asset, we know that, we see that a lot. Factory, so manufacturing. Buildings is it's factory buildings, but it's a fixed asset. Purchase of raw materials is in the manufacturing, raw materials, of course. The bad debt provision is a current asset as a minus. And the increase in BDP is trading again as an expense, as a selling expense. So, have I any extras here? Well, of course I do. This profit and loss balance, just take a note of that, 22,000, it's a debit, go on the debit side. Carriage on raw materials, that is raw materials, so it's manufacturing. Could go in at the top. Debtors and creditors advertising. Direct factory wages and is a prime cost up at the top in the manufacturing. Admin is admin. See what I did there? Sorry. The general factory overheads incorporated suspense. I had it as the selling expenses. So I'm just going to go back and change that. Selling expenses incorporated something else. So now it doesn't really change anything in this bar, the first number. So the general factory overheads were 75.1. So but what it does do, now I wouldn't have seen this till I got to putting the stuff in. It says selling expenses incorporate 3 months investment income. So we need to take those investment income 3 months out by adding it back on, because selling expenses is a debit, investment income is a credit. So it's a combination of a credit and a debit. So when they've come together, it's actually reduced our selling expenses. So we'll find our 3 months investment income and we'll fix that. So that is going to be 3/12 of, sorry, 3/7 of 3,500. So 3,500, 3 months out of the 7 is 1,500. So 1,500, that gets added on to our selling expenses. Would have been easy enough to fix that or to miss that, but you would have came across it putting your numbers in. So you add that 1,500 onto your selling expenses, which is 26.4. And then that 1,500 is no longer due. So it gets taken out of investment income due. So there's another 1,500 received. So you only are due to get 1,000. Okay. The reason why it's a good idea to mark things off. Admin's going in admin. General factory overheads I've just fixed there. So they're my 3 opening stocks. So finished goods in the trading and the other 2 in the manufacturing. Now look at this, 9% debentures, including 50,000 issued on the 31st of the 8th. I don't think it told me to work out mortgage interest, did it? It didn't, but what we'll do is we'll work out mortgage interest there, and we'll work out any mortgage. There might be mortgage interest due, of course, but mortgage interest is 9% of 250 by 9% of 200,000, because of this 50,000 increase on the 31st of the 8th. So for the first 8 months of the year, you had 200,000. So by 8/12, which is 12,000. And then for the remaining 3 months of the year, you have 250,000. Which is not that much, which is 5,625. So that's 17,625. Now you'd have to assume there's no mortgage interest paid here. So all of that is due. All right. So it doesn't tell you you've paid mortgage interest, I don't think. So all of that 17,625 is also due. So that's a current liability. That'll be trading. Selling will be the selling and distribution. Nothing to do with that. So other than, just don't do that actually, just to show you where that came from. But you don't do anything with that. Royalty payments. Royalty payments are an expense. Now, royalty payments will go into the manufacturing account. You generally get royalty payments from making stuff. Uh, so that'll be a direct cost. One of the prime costs at the top. Rent, you see, is credit side, so other operating income. PAYE, we've changed. Investments will go into fixed assets, and patents will go into fixed assets as well. So it's quite a lot in that. We can go about getting everything in now. Obviously, if you can be pausing this and going back and checking any of those workings as you go. So again, just like not the way I would normally do it, but I would start at the top and work my way down to the bottom. So my opening stock of raw materials is, I'm just going to make this a little bit smaller so we can get the columns in. So my opening stock of raw materials, 36.2. Okay, so my purchases of raw materials, excuse me, 3974. And you can be ticking these off as you go. Now, you also have a carriage on raw materials, which you wouldn't necessarily have. Now, I used to always keep that in the skeleton in the older questions, and it hadn't been asked in a couple of years on the leaving cert, so I took it out. So just it'd be one to check before you start writing the thing out. So the carriage on the raw materials is 3,600. Okay, where the hell is it? There it is up there, 3,600. So we add those together. Going to take out our closing stock of raw materials from our workings page, which was somewhere. We definitely changed it when we made the. Did we change the? No, we did. 25,100 from the question, and then we'll add that on, and how have I managed to do that? Carriage and raw materials. Sorry, there was no need for me to do that. So opening stock plus purchases plus carriage minus closing stock gives us our cost of raw materials consumed. So then we've got our manufacturing wages or direct factory wages, which were changed. So 150, where were they? Factory wages, 150, 600. Okay, so we'll stick them in. That's a prime cost, so we'll add that on. There was no hire of special equipment in this case. Maybe there was. There is, of course, 22,300. But there was an extra one, if you remember, that I said was a prime cost, which was our royalty payments. So a royalty payment is prime cost. Now, I'm not sure. I must check the American scheme and see if you put the royalty payments in as a overhead, would you lose out on many marks? But we'll have a check in a minute. So we add those together. So we're adding from the cost of raw materials, add on your three direct costs, and that'll give you a prime cost of 596 200. Now from there you're onto your factory overheads. So what have we got? Well, we've got our general factory overheads that we always have. These are all of our other expenses really from our trading profit and loss account. So general factory overheads had changed. They're 79.50. They were the ones that incorporated the suspense. We have anything to do with our plant and machinery. So we've our depreciation of plant and machinery, which was, sorry, depreciation of machinery is 22.8. And of course we had our loss on the sale of machinery, which wasn't too much, 5,900. So just if that was a profit on the sale of machinery, it would come down here and you would actually take it away because it would reduce your overall expenses of doing business. Remember, everything really here is added on except your closing stocks and your anything that would add to your anything that would be another operating income with your factory gets taken away, because all of this is to find out one figure, your equivalent of purchases in the trading profit loss account. Anyway, we'll have a quick check, see if there's any other ones that are to do with the manufacturing. We've got factory wages in, we've purchased raw materials in. No, that's them all. So we'll add those three together and we add them on. So this is all about finding out a cost. So obviously your costs start growing. Uh, so none of them are actually reducing your costs. Now, so the work in progress, that's your stock of work in progress. Add that on. And then take away your closing stock of work in progress from down at the bottom. That'll never change. So we can know that can go straight in. Okay, so that's 703,550. Then we've got our sale of scrap material. That was definitely had a working for it from the depreciation working, so somewhere near the top. Sale of scrap 3.1. Of course, you could be throwing these in as you do them. That 3.1 gets reduced, so you've got money in, so it reduces your cost of running your factory. If there's a profit on the sale of machinery, that will go in there as well. There's no profit on the sale of machinery, so there was a loss. So our final figure then, we're going to reduce by 3,100. So your cost of manufacture is 700,450. Okay, so just a quick recap of the things that we had to do slightly different. We had to put in the carriage and we had to put in the royalty payments up the top. Okay, and remembering to put in take away our sale of scrap material at the bottom. Everything gets added except for closing stocks and the sort of other operating income type ones here. So everything else gets added. So you'll see we've taken away closing stock and we've taken away closing stock and we've taken away sale of scrap. That's all we've done. Okay, so that's all to find out your, in effect, your purchases. So we take that number, 700,450, and we're going to move it over here. So you see I have that as goods transferred at cost of manufacture. It's just cost of manufacture. Okay. So our sales, right? It's trading profit loss account. We definitely adjusted. Did we adjust sales? We did with the goods in transit working. So where is it? Probably screaming at me here. So 1443. Now, opening stocks, finished goods, you can always look to the question for opening stocks. They're never going to change. So 37.5. Add your cost of manufacture, take away your closing stock of finished goods. That definitely changed. So 73.2. That gets taken away. So opening stock plus purchases minus closing stock. Take them away from your sales and that'll give you your gross profit. Now, hopefully there's not too many expenses in this. And normally with manufacturing accounts you've less expenses, but some of the mock ones is quite a lot. So we look and we'll see what do we have. Administration wise, well, we've admin. If administration itself, that didn't change, so 38.2. Now normally you would also have depreciation of buildings, but there's no depreciation of buildings in this one, so we can skip that and we can go on to our selling and distribution. You could also have rent, but rent is another operating income in this case. And they could tell you to put some of the general overheads into the trading profit and loss account, but they haven't. So we only have admin. Our expenses then, we know we have selling expenses. That's one that we changed towards the bottom. So I'm just remembering that to put it in. So that's 27,900. I'd say that was worth a load of marks because that would have caught out people. So what other ones do we have? Let's have a look. We had the advertising. Remember we split that up. So advertising is 800. We had those two. Any other ones there? Discounted, that's another operating income. Let me just check. So we should have all of our expenses in at this stage. So stock, finished goods, sales in, machinery, fixed asset depreciation, that's in. Feel like I'm missing out on one or two. Oh yeah, we've got the increase in bad debt provision, 1392. Okay, so I'm going to take a chance and assume that that's all that we have. I'll go back and I'll check in the main part of the question in this for a second. So those expenses get taken away. Okay, so 68,292 it needs to get taken away from our gross profit. Now, there's a couple of other operating incomes that I need to add in. So we've got, certainly have one, if not two, because we mentioned the rent. So rent of 16,700, that gets added on. And there was a discount, wasn't there, from the suspense working. So discount of 7250, and that needs to get added on as well. So we'll add them on, and that'll give us our operating profit. So 733,908. Geez, I'm not happy with that 8. Anyway, less debenture interest. So we worked that out at the end. It didn't tell us to do it. It gave us debentures, so therefore we should have debenture interest or mortgage interest in this case. So it's 17,625. Now, I can see a mistake already there. So if this is 8 and this can't be 3, that must be 4. So I'll just change that. Just check the months on that actually. So the mortgage interest is 31st of the 8th, so it's going to be 8 and 4. So just by checking that, so it's 19,500. Okay, so your mortgage interest is 19,500 to be taken away. And that'll give you your tax before profit of 714,408. Now, I have a feeling this is a sole trader in the manufacturer. Well, it says he's a company. It doesn't tell us anything about the taxation. So we can leave out profit before tax, profit after tax. They can disappear. Okay, so dividends. There was a dividend paid, all right. Of, do you know what I didn't do? So I never put in my investment income. So I'm going to add in my investment income here, which was the 3.5, I think, wasn't it? Yeah, 3,500. That's a plus. So that number is going to be 733,908 minus 19,500 plus 3.5, which is 717,908. I need to take away my dividends, if there is dividends. So there should be dividends if they're a company. Maybe not. Oh, there is 22.6. That'll give you a retained profit. And remember then, you have to take away your profit and loss balance of 22,000 at the start because it's a debit. It's like an expense. Yeah, it'd be a miracle if this whole thing balances at the end of this. I've made quite a few mistakes, but we'll see. So that's 673,308. Okay. Excuse me. We'll move on to our balance sheet. Normal balance sheet layout. So we've got our patents. So we had patents in the question. The patents weren't written off, so they should be able to go in. I think it was patents. There should be patents. If there's royalty payments, there has to be patents. Maybe some. Oh, there they are, right at the bottom. 24,000. Then you'll have your fixed assets. So you've got your two. Your factory buildings, which is great because there was no depreciation. But those factory buildings in the answer, they're 100 and or 1.43 million. Okay, there was accumulated depreciation 1350 down to 1310, which is 40,000. Okay, that remains constant. It doesn't matter that buildings have changed. And what that's saying is that the cost is 1350, the agreed depreciation is 40,000. So if buildings go up, depreciation stays at 40,000. So just take them away from each other and you get 1390. Okay, your plant and machinery. So that's from our workings. It was 224 2 something. Yeah, 224. And the number we're looking for depreciation is 70,200. Which we'll take away as well. And there shouldn't be any other fixed asset. All right, so just we'll add up our fixed assets. Now, that's the number we're interested in there, really, the 1543800. Now, there's one more asset. There's investments. So 3% investments, 200,000. So our total fixed assets, 200,000, the 1543800, and the 24,000. So we'll add them all together. Which is 1767800. Now, my closing stocks. So my raw materials, that hadn't changed, 25.1. My work in progress never changes, so 15.4. And my finished goods, of course, had changed, 73.2. I will have debtors, and I know I've less BDP here, so I'm going to be careful about them. So I'm going to put in my debtors next. Again, I know debtors changed. So they're 34.8 and the BDP is 1392. So 34.8 minus 1392. Okay, so that's my current assets. I think is there any more? There's the advertising prepaid. So you'd see this quicker than me because you'd have the workings page in front of you, but you'd be ticking them off, I hope. So your advertising prepaid of 2.8, that's a current asset. And then of course you've definitely got investment income due. That was, remember, I changed that right at the end. I think it's down to 1,000. Yeah, investment income due is 1,000. So you'd be checking for any more. They'd have to be on the debit side here. Obviously, check your workings page as well. Just at a brief look, there's none. So we'll add all of those up. Then we'll go to our creditors, amount falling due within 1 year. So definitely have creditors. Creditors had not changed, which creditors will change in most questions, but it didn't change. So the creditors have to be on this side. It's 39.8. I definitely, what else do I have? Well, I had the venture interest due, I think. I'll have to see if this works out at the end, but yeah, it will work out. So it's the full amount, 19,500. If none of it was paid, well, then all of it has to be due. So 19,500 has to be due as well. So we have to pay 19.5. We haven't paid any, so therefore 19.5 is still due. We've got our bank. Our bank is 59.1, and we've got our PAYE and PRSI, which changed in the suspense working. So 77,000. Now, you may have VAT. No, so everything on this side is in. Again, we'll just take a chance that these all add up to these all are correct. Take them away from each other. So take our current liabilities away from our current assets, and you get a minus working capital of 44,492. So therefore, we'll take that away from the fixed assets of 176,700, and you get a total net assets of 172,308. So what do we have debentures wise? We've got 250,000. Then we've got our authorised and our issued share capital. Really important to put both in or you'll lose easy marks. So the authorised share capital is 700,000 and 250, which is 950,000, which you can double underline. The issued then is 650 and 150. So that is 800,000. No revaluation reserve in this question. So our profit and loss balance, Jesus, I want to be high, is 673,308. This is looking somewhat promising in that there's an 8 in there's a 308 in the other one. Anyway, we'll add those two together, and we'll add that onto the 250. There you go, 172,308 balances. So that's us finished. Tricky enough one. There's a few things I came across obviously as I was doing it. That's going to happen to you in your exams. Just don't panic and just fix them as you come across them. Um, just leave plenty of room between. Obviously, not what I do there. When you get to the end of what you think your current assets are, leave a couple of lines. When you get to the end of your current liabilities, leave a couple of lines, and it should work out just fine. Okay. Anyway, that's that done. We'll see you again.